Good evening, students. So today we are going to start the new topic, but before that, we will just discuss the transfer pricing, few topics which were remaining, right? That's what we are going to cover now. Before we start the new topic, what we are going to discuss today is tax planning, tax avoidance, tax evasion, all of that we are going to cover in today's class. Yes, Namita, transaction of sale purchase of goods or services is covered. It is covered. Yes. Okay, let's start with it. So, first I'll be dealing with section 93, which was pending from the transfer pricing chapter, right? So, section 93 talks about transfer of income to non-resident. So, what happens is, see, generally, ROR, as you know, is subject to the global taxation, taxability on the global income. RNOR is subject to the taxability of the Indian sourced income and business or profession outside India but managed from India. NR is only taxable on the income sourced in India. So it is possible that in order to reduce the tax liability, a resident Indian may transfer the ownership of the foreign asset to a non-resident. Quite possible. Because for ROR, the global income is taxable in India. So what he may do, he may transfer some of his foreign assets to a non-resident in order to reduce his tax liability. Though he would be principally having the control on the income from that asset. So that's where section 93 comes into picture. Right? Here, if there is transfer of income to a non-resident, here non-resident would also mean RNOR. So under section 93, non-resident includes RNOR. Why that is so? Because as I told you, for even the RNOR, only the Indian sourced income is going to be taxable, right? So therefore, it is quite possible he could transfer it to a RONR also, and therefore here the term non-resident also covers RNOR under section 93. That is why we have here inclusion of RNOR into the definition of non-resident. Is that clear? There are other sections also where NR includes RNOR. One other section is your section 92. Section 92, which is your transfer pricing applicability chapter. There also, remember this thing, NR includes RNOR. Is that clear? So even when there is a transaction with RNOR, then also in that case transfer pricing will be applicable. Is that clear? And the third section is 168. Even under section 168, the term non-resident includes RNOR. What is 168? That is regarding the executors. Is that clear? But most importantly, it's 92 and 93. Now, what does 93 says is, 93 says that if there is transfer of assets, right? If there is transfer of assets in a manner that the income from transfer of income from the transferred asset is payable to a non-resident. So if say for example a resident transfer his foreign asset to a non-resident or RNOR, and the income from this asset is also payable to the non-resident, right? And as a consequence of the transfer, the resident has acquired some right by virtue of which he has power to enjoy the income from the transferred asset. So it is quite possible that today he is not having the income in his hand, but the income will be payable to him by the non-resident or by any other person, right? So though he has transferred the asset, but still he retains the right on the income. And the income of the non-resident, which is there, would not be chargeable to tax generally. So what could be the cases? Say, for example, resident transfers foreign asset to this non-resident. Let's take an example to make you understand better. To a non-resident trust. To a non-resident trust in which this resident is, say, for example, a beneficiary of the income. Maybe not at this stage, but at a later stage. He might enjoy the income from this trust. So therefore, in that case, section 93 will be invoked. The income of the transferred asset would be deemed to be the income of the resident only. So the income would be deemed to be taxable in the hands of the resident. Is that clear? Is that clear? Another thing, say for example, the resident, instead of transferring it to a non-resident trust or non-resident individual, transfers the asset to a non-resident company, a body corporate. And the body corporate will allot it the shares. The body corporate will allot it the shares. Then the resident will be assessable in respect of the income of the company derived by company from those assets. So whatever the company, this asset will be transferred to the company, and whatever the income will be there of company from assets will be taxable in the hands of the resident. Is that clear? Is that clear? However, the onus lies on the assessee to prove that the transfer was not for the purpose of avoiding the tax, or it was for bona fide commercial purpose. So if the assessee is able to prove to the AO that this asset which was transferred was for bona fide commercial purpose or was for not avoiding the tax, then in that case the AO may not invoke section 93. Is that clear? So any asset which is transferred or any income is also transferred arising from any asset, or any asset which is represented by the accumulation of income from some other asset, all those things, if they are transferred to a NR or RNOR, they will get added in the income from that will get added in the hands of the resident. Is that clear? That is section 93. Clear? Any doubt? Is that clear? Okay. Now understand, how will you say that the person has the power to enjoy the income? So though what does the section say, that if the asset is transferred, but the income of the asset, the power over enjoyment of the income of the asset is still with the resident. So how will you know that the power lies with the resident to enjoy the income, though the income is payable to NR? So the section deems that the resident will have the power to enjoy the income if the income is dealt with by the person as to be calculated at some point of time to inure for the benefit of the transferor. So it is very well calculated that this would be the income and this would go to the transferor only. Or the income is in a such manner that the income increases the value of assets which are held by the resident itself. Or the resident receives at any time any benefit out of the income. Or if the resident receives any benefit. Or the resident is in a position to obtain the beneficial enjoyment of the income by exercising the power of appointment, right? Or the resident is able to control the application of the income, how the income should be applied. So though the income goes to the trust in our example, but the resident will say that, okay, this is how it should be applied. It should be applied for this purpose only. So he is able to control the application. So then in that case, it will be deemed that the resident person has the power over the income. Is that clear? Any doubt? Okay. Next section, we are going to talk about Namita, if the asset is transferred, yes, then the tax will be levied on transfer. But tax saved from income from asset is very less. It might not be the case. The income can be recurring. So the tax can be more on that, right, Namita? Okay. Next section, what we are going to talk about is section 94A, which is specific anti-avoidance measures in respect of transactions with persons located in notified jurisdictional area. Now, what is that? So the central government notifies certain countries as notified jurisdictional area. What are notified jurisdictional areas? What are these? Which these countries do not have effective exchange of information with India. So these countries generally are very, countries where there is a lot of secrecy. Here the secrecy norms are very high. So these countries generally do not share the information easily with the other country of their resident. So that leads to tax evasion, tax avoidance. These countries give impetus to tax evasion, tax avoidance. Therefore, India notifies these countries as notified jurisdictional area. At some point in time, Cyprus was a notified jurisdictional area. Now it has been removed. Because earlier it did not have the effective exchange of information. Now what happens if any country is notified as NJ? Then the transaction, if with any person located in NJ, would be deemed to be the international transaction. So transaction with any person in NJ is deemed international transaction. Is deemed to be the international transaction, and all the parties to the transaction are deemed to be AEs, even though they do not fulfill any of the requirement of AEs, right? And all parties deemed AE. So what will happen? Transfer pricing provision will be attracted, right? Also in this case, if the transfer pricing is applicable, if in this case the transfer pricing becomes applicable, then if you remember, we had certain tolerance band. We had certain tolerance band in case of the ALP. What was the tolerance band? What was the tolerance band? That if the variation between the arm's length price, right, and the transfer price does not exceed 3% of the transfer price. Do you remember? Then in that case, or 1% in case of wholesaler, then the transfer price will be accepted. This was for the arithmetic mean. So this will not be available here. So that is called as tolerance band. Tolerance band in case of arithmetic mean not available. Is that clear? That will not be available. Is that clear? Then, if the transaction is with a person located in NJ, if it is with the transaction is with a person located in NJ, or any financial institution located in NJ, that particular payment will not be allowed as deduction unless the assessee authorizes CBDT to seek the information from the financial institution. So payment to any financial institution not allowed as deduction. Further, any expense, allowance, any depreciation on the asset purchased from a person located in NJ would not be allowed unless the assessee furnishes the information and documents. So no deduction of any expense or depreciation on capital asset purchased from a person located in NZ. Also, any sum which is credited or received from a person located in NJ is deemed to be the income of the assessee if the assessee does not explain satisfactorily the source of such money in the hands of assessee. Sorry, in the hands of that particular person or in the hands of the beneficial owner. Is that clear? So, any receipt or credit, even though it may be loan, it will be deemed to be income of assessee if the assessee is not able to satisfactorily explain the source of the amount in the hands of that person. Finally, any payment which is made which will be made to the person located in NJ on which TDS is deductible. TDS will be higher of 30% rate under Act or rate in force. Is that clear? Clear? Any doubt? Namita, what is if XYZ MNC unable to make secondary adjustment? I didn't get your question. If you can elaborate. Okay. Next, we are moving towards the last section for this topic, 94B, which is limitation on interest deduction. Now, understand one thing, this is a very, very important section and are newly introduced through the base erosion and profit shifting action plans. Now, what does this section say? Understand first the motive behind introducing this section. So, see, whenever the assessee wants to have the funds, wants to use the funds, it can either have through the share capital or through the loan amount. Right? Only these two methods are there to take the funds, to employ the funds into the business. Now, the advantage of the share capital is that, the advantage of the loan is that the interest you will make the payment to your lenders. The interest which you will be paying to the lenders will be allowed to you as a deduction from your taxable income. However, in the case of the share capital, the dividend is generally not allowed as the deduction. Dividend is not allowed as deduction. So obviously, from the tax point of view, you would feel that loan is a better option compared to raising the funds through the share capital. Obviously, there could be commercial disadvantages of loan as compared to capital, but from the tax standpoint, loan offers you the interest deduction, which the share capital does not on dividend. So what companies have generally been doing are, they have been, instead of raising the share capital, say it is 1 lakh, they have been raising maximum amounts through loans. And this is called thin capitalization. That your capital is getting thin and the loan is getting added or accumulated to your balance sheet. And instead of raising the funds through share capital, you are raising the funds through loan and claiming the excessive interest deduction. So therefore, section 94B would limit the amount of interest deduction. What does it say? What does section 94B say? Section 94B says that the interest amount shall be restricted if there is an Indian company, if there is an, so let me just write it like this, if the borrower is the Indian company or a PE of foreign company. Indian company or a PE of foreign company in India who has made the payment of interest on debt borrowed, who has made the payment or who incurs expenditure by way of interest in form of debt issued by a non-resident. So the lender is going to be a non-resident associated enterprise. Is that clear? And the interest amount is greater than rupees 1 CR. Interest amount should be greater than 1 CR. Is that clear? So then in that case, this particular party or this particular transaction of interest will be covered by 94B. Also, this Indian company or PE of foreign company should not be a banking company, because banking company are excluded because they are in the business of lending and borrowing. Is that clear? So what happens? This interest will be subject to section 94B limitation. And what is the limitation which is created? The limitation which is created is that the excess interest what is your excess interest? Excess interest is your total interest which is there, to the non-resident AE, in excess of 30% of EBITDA. In excess of 30% of EBITDA. So your total interest expenditure, which is payable to the non-resident, enterprise, right? In excess of 30% of EBITDA. Or or the second is interest paid to the AE. Lower of this will be subject to disallowance and will be carried forward for 8 years. Is that clear? Is that clear? So if there is a non-resident, if there is an Indian company which is borrower of loan or debt from non-resident A on which it pays interest exceeding rupees 1 CR, then the excess interest, which is lower of total interest paid to the A minus 30% of EBITDA, or the total interest paid to A, whichever is lower, will be disallowed and carried forward for a period of 8 years. Is that clear? There is also one more thing over here. So this is one part of thin capitalization. Thin capitalization is also applicable, or limitation of interest will also be applicable where the borrower is your Indian company or PE of a foreign company. Your borrower is going to be an Indian company or the PE of the foreign company, and the lender is going to be a third party. The lender is going to be a third party. Any party can be a lender, right? Any party can be my lender. Now, if any party I say that can be my lender, if any party is lender, then you would say thin capitalization ideally should not be applicable, isn't it? Then the thin capitalization ideally will not be applicable. But what happens in this case is that here the associated enterprise which is there, the associated enterprise which is going to be there, that associate enterprise will be guaranteeing the loan taken by the borrower. That will be guaranteeing the loan taken by the borrower. So to understand it better, let me show you. So the borrower, as I said, is Indian company or a PE of foreign company, right? And this loan is borrowed, or let me write debt which is borrowed from a non-resident lender to whom you are paying interest. Now this particular loan amount is guaranteed by the associated enterprise. Are we understanding? So if the loan is taken by the Indian company or PE of foreign company who is making the payment of interest to any non-resident, but that non-resident may not be A, but the associated enterprise provides a guarantee to the lender or deposits a corresponding and matching amount of funds or that as of loan to the lender, then it shall be deemed that the loan have been given by the AE, and 94B will be applicable. So here on this interest amount, 94B limitation will be applicable. Is that clear? So the way limitation we have understood it earlier, that the excess interest will be disallowed, same way. So total interest paid to the AE minus 30% of EBITDA, or the total interest paid to the AE will be lower of that will be disallowed. Is that clear? Any doubt? Namita, income received from NJA will be taxable in India, but here we are talking about the receipt. Receipt could be a loan and not always income. So therefore, it is deemed that every receipt from person from NJ will be income. Is that clear? Yes, then it will lapse after 8 years. Okay. Let's solve a question from your module. There's one small question. Let's take it up and very quickly let's solve it before we go towards the next chapter. Let me just quickly share you the screen. A very small question. Question number 8. NP Limited, an Indian company, has borrowed 80 CR on 1/4/2021 from Messrs. TL INC, a company incorporated in London, at an interest rate of 10% per annum. The said loan is repayable over a period of 5 years. Further loan is guaranteed by Messrs. ST INC, incorporated in UK. Messrs. Street INC, a non-resident, holds shares carrying 40% of voting power both in Messrs. NP and Messrs. ST. Net profit of NP for 21-22 was 7 CR after debiting the above interest, depreciation 6 CR and income tax of 4 CR. Calculate the amount of interest to be disallowed under the PGBP in the computation of Measures NP Limited after giving appropriate reason. So very quickly give me the answers. Very simple question so far. Naveen, no, it's 50 lakhs. It's not 30. The answer is 50 lakhs. Let's discuss it. Yes, Naveen, 50. Yes, correct. Priya, 50. Yes, correct. Okay, let's discuss it. So if you see here that the Indian company is borrowing 80 crores rupees, right? And has incurred the interest expenditure which is exceeding 1 CR. So therefore 94B will be applicable. But who is the lender here? The lender here is, it has borrowed from Messrs. TL INC, right? Now TL INC is not the AE. The loan is guaranteed by Messrs. ST INC, right? And Messrs. Street INC, a non-resident, holds shares carrying 40% of voting power in NP and ST. So there's a common shareholding, and therefore NP and ST both will be the associated enterprise, because more than 26% is being held in NP and ST by TWEET, and therefore they are deemed to be the associated enterprise. And associated enterprise is guaranteeing the loan, right? So 94B is applicable. Net profit is how much? 7 CR. You will add back there 6 crores, 4 crores of depreciation, income tax, and 8 CR of your interest. That will give you EBITDA. 30% of EBITDA will be 7 crore 50 lakhs. Out of that, 8 crore 50 lakhs is your total interest paid in excess of EBITDA. Interest paid is 8 CR. Lower of these two is 50 lakhs. So therefore that will be disallowed. Are we clear? Any doubt? Any doubt? Okay. Let's move towards then to the next topic. Let's quickly move towards the next topic. Now, what is next topic about? Tax planning, tax avoidance, and tax evasion. I'm writing here 3 terms. Do you have any idea about the difference between the 3, or any 2 of it also? Anybody? Anyone can help me identifying the difference? Anybody? What is the difference between these 3? Yes, Jaydev, that's correct. Tax evasion is illegal. So, tax planning and tax avoidance, you mean they are legal? Any other difference, anyone? Very quickly. Using benefits given in tax to reduce tax is avoidance. No, that's not correct, Naveen. Okay, let's try and understand. What is the difference? So there is very thin line of difference, at least between tax planning and tax avoidance. Tax evasion, as Jaydev you rightly mentioned, this is completely illegal. Tax evasion is completely illegal for the fact that tax evasion involves the element of deceit, misrepresentation, fraud. So when the assessee falsifies the books of account, produces the false entries, it refers to the tax evasion. So if you remember, we had done the penalties chapter, wherein we had dealt with several penalties for giving the false entries. Do you remember all of that, right? So there we had discussed about that how producing the false entry, producing the false books of accounts, misrepresentation, through all of that, it leads to tax evasion. It completely leads to tax evasion, right? So for that, if you remember, we had a penalty section under section 270A, which was on misreporting of income. Right? For that misreporting of income, there were several sections therein. Several points therein when the misrepresentation is constituted. Misreporting is constituted. So when there is misrepresentation or suppression of facts, when the investments are not recorded in books of accounts, where the expenditure is not substantiated by evidence, recording false entry in books of accounts, failure to record any receipt in the books of accounts, failure to report any international transaction or specified domestic transaction, right? In all those cases, we said that it is misreporting of income and 200% penalty will be levied on underreported on the tax on underreported income. Yes, Priya, you are correct. Tax planning is to save the tax through government privileges exemption. Tax evasion is some sort of illegal mean to save tax or can be deceitful measure. Yes, absolutely correct. Yes, Namita, avoiding tax lawfully by using deduction is tax planning. Tax avoidance is avoiding tax by twisting legally law, and tax evasion is twisting law illegally. Very nice. Very nice way of representing. Yes, that's correct. So all of you have understood it very correctly that tax evasion is something which is illegal, where we misreport the income, where we give the false entries, where there is undisclosed income. On that also, if you remember, we had the penalty under section 271 AAC and the tax was under 115 BBE. There was also a penalty for false entry in the books of accounts under 271 AAD, where there was penalty for false entry, which was sum equal to the amount of false entry. False entry which included the intention to forge or falsify the documents, invoices, right? So we have done all these penalties already. And all that was to tackle or to put a curb on the tax evasion, isn't it? All that was to curb the tax evasion. That is tax evasion. Now we are coming towards tax planning and tax avoidance. As I said, there's a very thin line. And as you rightly pointed out, tax planning is something wherein you avail the tax exemptions based on what the law says. The law gives you the benefit and you are utilizing those benefits legally. You are utilizing those benefits legally. For example, let's take an example. I am a salaried individual. Now, law has given me certain benefits. Law has given me or allowed me certain benefits, right? What are those benefits for salaried employee? I have ATC. I can put it into PPF. I can put it into mutual funds, tax saving mutual funds. I can use tax saving FDs. This is how I can utilize my ATC investments. So at the start of the year, I can plan that, look, this is my salary and this is how I should be planning it around. So what I'll do is I will think about all the investment options, medical premium under ATD, any other deduction I'm able to avail. There are not much exemptions for the salaried person. There are very few exemptions, right? I can decide upon my salary structure for availing those exemptions. So I can ask my employer to plan the salary structure, keeping in line with the deduction and exemption available. So for example, instead of keeping everything 5 lakh as my basic salary, the employer can give me 2 lakhs as my basic salary, 1 lakh rupees as my HRA, so that I can get the exemption of the HRA. Because if the salary is paid as a only basic salary without any breakup, then there will not be much benefit. So I can ask my employer to split the salary into various allowances and perquisites so that I can reduce the tax in my hand. The employer can give me a children education allowance, some house rent allowance, so that I can claim the exemption for that. Right? Similarly, I can ask my employer to put certain amount of my salary into the provident fund, into the recognized provident fund, because the payment from these funds at a later point will be tax exempt. To put certain amount into gratuity. In that way, the employer will also get the deduction if he puts in the recognized provident fund. Employer will avoid putting into unrecognized provident fund because that deduction is not allowed, right? So I will ask my employer to contribute 12% of my salary to the recognized provident fund so that it will not be taxable. It should not exceed more than 12%. I will also look into consideration that whether my total contribution to NPS, all the provident funds, superannuation fund does not exceed 7,50,000, because if it exceeds, it will be treated as perquisite in my hands. Right? I will check whether any kind of salary which is given or salary component which is given is taxable as perquisite. So I will not take that as perquisite, but I will take it in the form of some other allowance. For example, any payment on the life insurance of the employee is treated as perquisite in the hands of employee. Or keyman insurance policy is also income in the hands of employee. Right? So therefore, I will look all of that into consideration. Is that clear? And that is the tax planning. So structuring of your salary is not really a tax avoidance, but it is tax planning. After weighing the pros and cons of all the options, what I have it. Is that clear? Any doubt till now? Further, for example, the Act has given me an option to pay the tax under 115 BAC or to pay the tax as per the normal scheme. So I will look upon to my salary structure, compute my income. I will decide whether I should want to go for 115 BAC or the normal scheme. And that is all what is tax planning about. Right? So that is my tax planning. Now, what is tax avoidance? Vidula, PF is beneficial or not? That's not the question. Vidula, PF has to be contributed by every employer. He will get deduction of salary also, he will get deduction of PF also. And PF is mandatory under the PF Act. So he has to do that. It is beneficial for employee because he will also get deduction and the employer's contribution is not taxed. If it is only salary, it will be taxed. If it is employer's contribution to PF, it will not be taxed. Plus my own contribution, I will get it as deduction under ATC. Right? Is that clear? Now, what is tax avoidance? Tax avoidance is a very complex thing. And that's where not the salaried people will get in. It is the job of the big companies. So, in the tax avoidance, they go by the letter of the law. What the law is saying by the literal interpretation. The assessees will harp upon that. How the law is being literally interpreted, and if by the literal interpretation I am getting some benefit, I will go with that benefit, even though that may not be the intent of the law. Even though it may not be, or it may be against the intent of the law. A clear example I will give you. Say for example, the Act says that if you start some infrastructure project Or if you start some specified business, you will get 3580 deduction. Right? So what the assessee will do is, he will open up another company. He will try to shift the goods or services from non-tax holiday undertaking to the tax holiday undertaking, right? And that is what the tax avoidance is. Or say for example, let's take an example that, say we have a tax treaty with USA. Say we have a tax treaty with USA. And under India-USA tax treaty, capital gains are taxable in India. So in order to avoid that capital gain tax, I will see that if there is a favorable treaty with, say, Mauritius, wherein capital gains under the India-Mauritius treaty are not taxable in India. So I will open a sham company in Mauritius, which will not have much of the business or business activity, and I will save my capital gain tax. So what I'm doing, I'm following the letter of the law very strictly, but that was not the intent of the law. So that is your tax avoidance. So that is your principally tax avoidance. So tax planning is something very legal. But tax avoidance is between two extremes of, it is neither tax planning nor tax evasion. It is something wherein you are planning your taxes within the letter of the law, but it is circumventing the intent of the law. So whether tax avoidance is legal or not is a very debatable question. It is legal because it is as per, as I said, the letter of the law, not as per the intent of the law. The question is not lying on whether the tax avoidance is legal or illegal. It is not illegal for sure. It is legal. But the larger question in case of tax avoidance is whether tax avoidance is moral. Whether it is morally right to avoid taxes. So there is a thought process that everybody should be paying taxes due to the government, to the society. But the corporates feel that why we should. And therefore, there is a larger question that whether tax avoidance is morally right or not. And how do we attack these tax avoidance schemes? So prior to 2017, these schemes could only be attacked by way of a judicial process, by way of the court examining these transactions. There was no formal tax avoidance measures under the Act prior to 2017. So it was only for the courts to examine that scheme, and the courts had come up with several doctrines to examine that whether these schemes are permissible or not. Right? Other than that, we had certain specific anti-avoidance measure, SAR. For example, we had as a SAR transfer pricing, wherein we were attacking the transaction or the base erosion which is caused due to the profit shifting or excessive interest, excessive deductions being claimed by the companies by manipulating the pricing between the related parties. Right? For example, we have thin capitalization, again where we are trying to counter the interest deduction, which is excessive interest deduction being claimed and siphoned off to another country. Deemed dividend under 222E, where the profits in guise of loan and release of assets are being distributed to the shareholders. Place of effective management concept, where the Indian companies were trying to avoid their residency in India. Indirect transfer, where the transfer of a capital asset is situated outside India, but in effect the Indian company's assets were being transferred, or Indian company's share was being transferred, deemed this gift tax, right, under 56(2)(10), clubbing provisions, right, section 93 what we just talked about, all these were specific anti-avoidance rule. But these are applicable to a particular transaction. For example, a transfer price. For example, the deemed dividend. It is not something very general. But there could be the transactions outside this also. So the courts were dealing with it. There was a very landmark case on tax avoidance, the very earlier case, which was not Indian case but the England case, in the case of Duke of Westminster. In this case, it was held that this was very landmark case and it was followed globally at that point in time. It was held in that case that every man is entitled to arrange his affairs so that he can reduce his tax liability. And every person is entitled to arrange his affairs in such a way so that he can reduce his tax liability, even if that may not suit the commissioner of the tax. So any person may not be compelled to pay an increased tax. This principle was being followed for a very long time. Very, very long time. Wherein the courts had given the tax avoidance a green signal that you can arrange your affairs in the best possible manner to reduce your tax liability. That was being allowed by the courts. It was only when in 1980s when another decision came up in the case of Ramsey, which was again a UK decision, wherein this case departed from the Westminster's principle. So Westminster's principle said that you don't need to look behind the transaction. If a person has arranged his affairs in a way to reduce his taxes, that's all right. Right? But in Ramsey case, the court said that you don't need to look into the transactions in an isolated manner. You need to look the transaction as a whole. That there is nothing in the transaction which is sham. Which is sham. So the court said that it is task of the court to ascertain the nature of the transaction. And therefore, this particular case was a clear departure from the Westminster principle. Right? The Ramsey principle stated that at every step in a transaction, you have to see that whether it is a genuine step producing the intended legal results. Right? In the context of India, these were the global decisions, right? But in the context of India also, the Westminster principle was followed in a case of A. Raman. This is an Indian case. So India also followed for a long time the Westminster principle, wherein it was held that avoiding the tax liability by arranging the affairs is not prohibited. The taxpayer can enter into transactions which result in lower tax liability. So that particular decision, from then onwards, India was following the Westminster principle. It was only when the judgment of McDowell came. McDowell was a case of excise, not of income tax, wherein the person was collecting the excise from the customer. The court said that understand, tax avoidance is very sensitive. It leads to loss of public revenue. It leads to accumulation of black money. It leads to inequality between the people. And therefore, what is here important is that here the question should be asked is whether tax avoidance is morally correct or not. And the court said, here one need to see that whether we should look at the literal wordings of the provision or the intent of the provision. And the court said that here the tax planning may be legitimate, provided it is within the framework of the law. But colorable devices, any artificial transactions cannot be part of tax planning. So the court said it is very wrong to encourage that avoiding the tax payment is legal. That's not legal. Every citizen is obligated to pay the taxes. And therefore, the court gave a red signal, a clear no to the tax avoidance from the McDowell's case. But again, very recently in 2013, there was a Supreme Court decision in the case of Azadi Bachao Andolan. And the famous Vodafone case, what you would have learned in your international tax class. Here, again, the Supreme Court gave yes to tax avoidance. So in McDowell, it was held that tax avoidance is not allowed. But in Azadi Bachao Andolan case and in Vodafone case, it was said that if the taxpayer is arranging his affairs in such a way as to reduce your tax liability and there is nothing in the Income Tax Act to stop him, then the tax avoidance cannot be put a halt. If you want to put a halt, bring the rules under the Income Tax Act. And that is where in 2017, General Anti-Avoidance Regulations came into picture. General Anti-Avoidance Regulation came into picture. Is that clear? Any doubt till now? Namita, Namita, the chapter number here in your module, I think, is chapter 14. It's chapter 14 what we are discussing, which is tax avoidance, tax evasion, and tax planning. Clear? Okay. Let's Azadi Bachao case. Naveen, this was a case in the context of India-Mauritius DTAA. So the example which I gave you, that India-US DTAA did not have, India-US DTAA provides for capital gain taxability in India. India-Mauritius DTAA does not provide for capital gain taxability in India. So I will incorporate a sham company in Mauritius, which will be controlled by US company only. But there will be a sham company in Mauritius. So instead of coming through US, I am coming through Mauritius. And in Azadi Bachao Andolan case, that was permitted. It was exactly that case. Clear, Naveen? Okay. So therefore, there are series of decisions. As I said, prior to 17, the Supreme Court, the High Courts used to rule on the tax avoidance and tax evasion. But now we have, under our Income Tax Act, the concept of GAR. So earlier the courts were ruling, as I said, various doctrine of form versus substance, whether the form should be looked into or whether the substance of the transaction needs to be looked into. So generally, there were certain courts wherein it was held that earlier that unless and until the transaction is sham or is with a bad faith or fraud, then you look only into the form. Only when if the transaction is of bad faith or fraud, then only you go to the substance of the transaction. Then only you can lift the corporate wheel. You would have learned that in your corporate law also, right? In several cases, it was held that the taxing authority are entitled to determine the true relation from a transaction. It is open for the taxing authority to look behind the transaction and to determine the true character of the transaction. Right? So, different courts had ruled different principles with respect to the substance versus form. Is that clear? Any doubt? Any question, any doubt? Even with respect to the companies, tell me one thing, whether it is tax avoidance or tax evasion. Two questions to you. With respect to the companies, opting for 115, BAB, BBA, all those schemes, alternate scheme instead of 30%, is that tax planning or is that tax avoidance? Opting off the alternate scheme. So a company has a choice to go for either 25% tax rate or the 30% tax rate or the 15% tax rate, right? So whether that is tax planning or it is tax evasion or tax avoidance. Yes, Ridula, correct. It is tax planning. It is not tax avoidance. Right? So that is the case of tax planning. So when a company is selecting an option, it is not with the intent that to avoid taxes. So the company can select any of the scheme, but provided it should also show the business activity. It should not be the case that it is only a sham company opened up to take the benefits. If that be the case, it will be a case of tax avoidance. What about choosing the form of the business? Whether I should be going for LLP, I should be going for company, I should be going for HUF, whether that is tax planning or tax avoidance. What do you think? Choosing a business form, whether that is tax avoidance or tax planning. Namita, it was not revised, it was overruled after the Vodafone decision. Priya, you are saying tax avoidance. Naveen, you are saying tax planning. It is a planning. I have been given an option to either start my business as a company, as an LLP, as a partnership firm, as HUF, as individual sole proprietor. So it's no tax avoidance. It is tax planning only. So choosing the right legal form is tax planning and not tax avoidance at all. Are we clear? Any doubt? Any doubt? Similarly, as I said, when you are doing a business, you would either use the funds from the share capital, from the borrowings, loans, debt, debentures. So again in that, It is a tax planning, but again we have a specific SAR for that, which is interest on thin capitalization, because it should not so happen that only for the purpose of claiming the interest deduction, you are borrowing the funds by way of debt instead of share capital, which is what I told you is thin capitalization. If that be the case, then it is tax avoidance. But choosing the right funds commercially with commercial standpoint is just tax planning. Because I am getting interest deduction, that is my tax planning. But it should not be without the commercial purpose. If it is without the commercial purpose, then it is of course tax avoidance. Clear? Any doubt? Similarly, the way you are acquiring your asset. So whether you should be buying the asset, because if you buy the asset, you will get depreciation. But if you lease out the asset, you will have the entire amount as deduction of hiring charges. Right? So if you hire the asset, the higher charges will be allowed as deduction. So based on that, you will decide that the acquisition of asset, whether it should be by way of buying or by way of hiring. Similarly, in case of plant and machinery, you will decide whether it is I should buy, because you will also get additional depreciation. You may also have some scientific research deductions. You may have 35 AD also in that case. And these are all planning, because you will have to see that what are the options available to you. Right? Is that clear? There is also possibility that you may go for a second-hand imported plant and machinery, because you have that 20% limit, right, for the additional depreciation. So all that while taking into consideration, while you will have to plan your taxes. This is all planning. Is that clear? Any doubt? Any questions? Any doubt? Okay. So let's proceed further then. As I said, let's solve one question before we go for a break, which is in respect of the 115 BAC, 115 BAB and 115 BAA. So from your module only, we have one question. And let me just share you the screen. The following are the particulars relating to two Indian companies, namely Alpha and Beta, which are subject to tax audit under 44AB. Date of setting up or registration, main object, manufacture of steel, place, turnover of previous year 1920, turnover of 2021, 21-22. Value of new plant and machinery installed and put to use on 1st November, gross total income, number of employees employed by the date of setting up or registration, monthly emoluments to employees by ECS through bank account. Compute the tax liability of Alpha and Beta, assuming that they avail the beneficial tax rates by fulfilling the conditions specified therein. Assume the GTI reflects the computation under the special provision. Would it be beneficial for Alpha to opt for special provisions instead of opting for the regular provisions? Assume Alpha has not opted for 115 BAA in earlier years. So this is your question. Give me the answers once you solve it. What are your answers? Very quickly. What are your answers? Last 2 minutes and then we'll solve together, otherwise. I'm waiting for your answers. Okay, let's solve together if you are not able to come to answers. Naveen, you are saying that it is not beneficial for alpha to go for the alternate scheme, right? This is what you're saying? Anybody else? Okay, let's do it together. So, if you see here, the gross total income which is given, gross total income is already given to you, which is 5 crores and 10 crores for alpha and beta. What is your important is your 80JJAA, right? For alpha, you will give first 20,000 for 250 employees for 12 months. It is per employee, right? It is per employee. 20,000 is per employee and it is for 1 month. So for 12 months, similarly, 25,000 for 12 months for 250 employees and 28,000 that will not be given, right? So Alpha Limited will claim 80JJAA. Since the employees are employed on 1/4/2019, it can claim 30% of additional employee cost for 3 years, 1920, 2021 and 21-22. Employees are employed for on one second. Employees are employed in 2019 because the company is in operation since 1/4/2019. So it is clearly written that these employees are employed on the date of setting up or the registration of the company. So the 80JJAA deduction is available for 3 years. So the employees whose emoluments are 20,000 and 25,000 only will qualify. Those which are exceeding 25 will obviously not qualify. Similarly, for beta, you will do 21,000 into 250 into 12 and 25,000 into 250 into 12 and 30% of both these costs. So that will give you the total income which comes to 95 lakh for alpha and 1 crore 27 lakh for beta, which is given here also if you want to see the answers. Right? Now, if they are saying that they can go for the alternate tax, right? Alternate tax. Now, if you see, for alpha, it is in the manufacture of the steel. So alpha is eligible to opt for 115BAA, under which the tax rate would be 22% plus surcharge of 10%. Whether it can also go for 115BAB, since it is into manufacturing, for 15% tax rate, whether it can go, the answer is no. Why? Because only the existing companies can go for 115BAB. Sorry, BAA. For 115BAB, the company should have been incorporated after 1st October 2019. Here, if you see, Alpha has been incorporated before 1st October 2019. So it is not a new company after 1/10/19. So therefore, it is an existing company and it can go for 115BAA. And it is not eligible for 115BAB. So we will have 22% tax rate for alpha plus the surcharge of 10% and the HSC for 4%. Right? That's for alpha. For beta, it can go for 115BAA also. Beta can it also go for 115BAB? The answer is yes, because beta is incorporated in 2021 and it is in the manufacture of leather. Right? And therefore, the beta, the tax rate will be 15%. Beta, the tax rate will be 15% plus surcharge of 10% plus 4%. Right? Also remember one thing, since it is in the manufacture of leather, 80JJAA is applicable and that's what we have taken into consideration. So this is your tax liability which will be coming up with respect to alpha and beta. Now, as per the regular provisions, as per the normal provision, the gross total income is given, right? The gross total income is given to you. Now, if you see, the value of plant and machinery installed and put to use is given to you. Why that is given to you? For the purpose of your additional depreciation. Because additional depreciation will not come under 115BAA and 115BAB. It will not come under 115BAA and 115BAB. So you will take into consideration additional depreciation on the plant and machinery of rupees 8 CR. That's for alpha, right? And you will give the deduction of 80GGAA also and compute the tax liability. Now, what will be the tax of alpha, normal tax? What will be the normal tax of alpha? The normal tax of alpha will be 30%? Answer is no. Here, if you see, the turnover is given in the question. So, if you see the turnover of Alpha Limited, the turnover of Alpha Limited of previous year 1920 is less than 400 CR. So, therefore, the normal tax will be 25% tax. And this is how you will compute it. GTI, less additional depreciation, GTI, deduction under section 80GGAA, total income and tax will be 25%. Surcharge will not be applicable as the total income is less than 1 CR and the total tax liability will be 3,90,000. And the tax as per 115BAA was 23 lakhs. Whereas the normal tax is just 3,90,000. And hence the alpha should not opt for 115BAA. Are we clear? Naveen, the additional employee cost, this is from 2019 only. This is not new employees and they will get it for 3 years. These are not new employees. Are we clear? Okay. Let's take a small break of 10 minutes and then we get back. Let's take a break. Okay. Vidula, your question is, the question is not clear about additional depreciation. So since information is given, we have taken additional depreciation and there is no information that whether the total income includes it. Ideally, your question is clear, but this is a kind of an assumption which is being made in this question. That since the information regarding the asset was given in, therefore the additional depreciation is not taken into consideration. You can assume otherwise also. Okay. Now we are proceeding towards the last part of this chapter, which is, as I told you, that earlier the judicial decisions used to guide, but since 2017, we have something called as General Anti-Avoidance Regulation, which is called GAR. This has been in effect from 2017 onwards. So the General Anti-Avoidance Regulations is in effect since 2017. Now, what is General Anti-Avoidance Regulation? Let's try and understand. Is it towards the tax planning or is it towards the tax avoidance or tax evasion? So as I said, tax evasion, understand one thing, it is illegal. So there was no need of having the GAR for that. It is very much clear that it is illegal and we have a set of penalties for that already in place. So there was no need of GAR for that because it was very clear that tax avoidance, tax evasion is illegal. Similarly, tax planning is legal. It will always be legal because the Act only provides for it. Claiming ATC is not tax avoidance. The Act tells me and I'm just structuring my taxes within the framework of law. So again, GAR is not attacking tax planning also. GAR is specifically there for tax avoidance. Because it is a tax avoidance which was not very clear with that whether it is permissible or not. So therefore, it is a tax avoidance which is going to be targeted by GAR. And GAR is not just with India, but many countries have GAR. Further, now we have a treaty GAR also, which is called as Principal Purpose Test, which is by virtue of the base erosion and profit shifting action plans. So the way we have domestic GAR, we have the treaty GAR also. GAR was introduced in 2012 in the Direct Tax Code Bill, but direct tax never came into effect. Then it was introduced by Finance Act 12 in the Income Tax Act, and it was kept on differing, and it finally came into picture in 2017. So from financial year 17-18, GAR is applicable. Now what is GAR? GAR is basically the anti-avoidance regulation which seek to tackle the tax avoidance transaction. So section 95 of the Income Tax Act deals with the applicability of GAR, which provides that if there is a transaction, it provides that if the assessee has entered into an arrangement, any arrangement where the tax benefit is greater than rupees 3 crores. Where the tax benefit is greater than rupees 3 crores. And that arrangement is an impermissible avoidance arrangement. That arrangement is an impermissible avoidance arrangement. Then the GAR will be invoked. So section 95 says that an arrangement may be declared as an impermissible avoidance arrangement. And if it is declared as impermissible avoidance arrangement, then the GAR will be applicable. Now the GAR is a code in itself. It starts with a notwithstanding clause. So even if some provision of act is there, but it overrides all other provision of that act. Not only that, it also overrides the benefit given in the tax treaty. So section 90 provides you the treaty benefit, but section 90 subsection 2A provides that nothing contained in section 92, notwithstanding anything contained in 92, the GAR will apply to the assessee even if the treaty is beneficial. So now, even if Azadi Bachao Andolan case or Vodafone case had given the benefit to the assessee, now from 1780, arrangement is such that it may be declared as impermissible avoidance arrangement, then the GAR will override the tax treaty. Are we clear? The GAR will override the tax treaty. Now, what is an arrangement? Arrangement is defined under section 102. It says that any step or a part of or a whole of any transaction, operation, scheme, agreement or understanding. So even a part of the transaction, any step or even the part of a transaction, that also can be an arrangement. Not even if the entire transaction is not towards tax avoidance, but if a part of the transaction. Right? Then that also is covered under the definition of arrangement. Is that clear? So say for example, let's take an example that there is an Indian company. It sets up a unit in SEZ for manufacturing and claims the deduction under section 10AA. Then in that case, the GAR is not applicable because this is a tax planning. The Act gives you the benefit of SEZ deduction under 10AA, and if you have set up an entity, you will get the deduction. There is no problem in that. So GAR will not come and interfere with that. However, let's take another example. Say there is an Indian company. It has one unit for manufacturing already in a non-SEZ unit. Now it sets up another manufacturing unit in SEZ. But what it does is, the SEZ unit only does the packaging. The manufacturing is entirely carried out by non-SEZ unit. Whether in this case the GAR is applicable? So this is a case of tax evasion, because in this case, the assessee has misrepresented the SEZ unit as a production or a manufacturing unit. Here, manufacturing is being carried out by non-SEZ unit only. And as I said, tax evasion, if it is there, then GAR will not be applicable because this is clearly illegal. Right? Third example, same thing. But let's assume that the Indian company has SEZ unit and a non-SEZ unit. Now the non-SEZ unit transfers the product at a price lower than the fair market value. And SEZ unit does some insignificant activity. So the products are being transferred to SEZ unit, and from SEZ unit they are sold, so that higher deduction can be claimed there. So can GAR be invoked? Here we already have, if you remember, we already have this thing covered under specified domestic transaction, wherein we had dealt with the situation that if the goods are transferred from non-SEZ unit to the SEZ unit and the profits are resultantly transferred from non-SEZ to SEZ, specified domestic transaction will be there if the transaction value is exceeding 20 crore. Even otherwise, if it doesn't exceed 20 crore, we have the anti-avoidance provision under 80 IE 8. So therefore, there is already a specific anti-avoidance regulation already there. But still, if the specific anti-avoidance regulation under ICAI or for that matter under 92 BA for specified domestic transaction, if that is not able to tackle it efficiently, we can still invoke GAR. So GAR and SAR can coexist. Even if we have a SAR already present, transfer pricing already present, but if the transfer pricing rules are incapable of tackling this kind of tax avoidance and there is much more into it, the GAR can be invoked. The GAR can still be invoked. Is that clear? Right? Or for that matter, let's take another example. That if, say, for example, the assessee starts a new SEZ unit, but it does all from restructuring its earlier operation. So for that also we have a SAR, that restructuring is not allowed. But if SAR is not able to deal with it, we can still invoke GAR. So GAR and SAR can coexist. Is that clear? Is that clear? Now, what is the meaning of impermissible avoidance agreement? What is the meaning of impermissible avoidance agreement? Let's try and understand. Impermissible avoidance arrangement means an arrangement. So, we have already defined what is an arrangement. Right? The arrangement term is already defined under 102. What I told you, step, part or whole of transaction. Impermissible avoidance arrangement is basically an arrangement. The main purpose or one of the main purpose. So there is a purpose test. So main purpose or one of the main purpose. Understand, this is one of the very important words. Is to obtain tax benefit. Is to obtain the tax benefit. Is that clear? So where the arrangement has main purpose or one of the main purpose to obtain the tax benefit. And then this is one test, purpose test. Second is a tainted element test. So these are the tests for constituting what is an impermissible avoidance arrangement. This is defined under section 96. Now, what are the tainted element tests? Let's try and understand. Creates rights, obligations, which are not created between persons dealing at ALP. So if the arrangement results in some kind of arrangement or transaction between two persons which should not be between the persons who are dealing at arm's length price, and the main purpose is to obtain the tax benefit of that particular obligation or a right, then in that case it is impermissible avoidance agreement or an arrangement. Second, results directly or indirectly in misuse or abuse of provisions of this act. Misuse or abuse of provisions of the act. So if the transaction is for abusing the act, that is covered under impermissible avoidance arrangement. Lacks commercial substance. Lacks commercial substance. And finally, is entered into or carried out, is entered into or carried out in a manner not ordinarily for bona fide purposes. So basically, tainted element test is that the rights, obligations are not at ALP, results in misuse or abuse of the provision of act, lacks commercial substance, is entered without the bona fide purposes. Then in that case, it can be taken as impermissible avoidance arrangement. What do we mean by lacks commercial substance? What do we mean by lacks commercial substance? So let's try and understand. First thing, let's understand what do we mean by creates rights or obligations which are not created between the persons dealing at arm's length price. So this is the first test, right? Then it refers to non-arm's length dealing, where an arrangement creates any rights or obligations which are not done normally between the unrelated parties or parties dealing at arm's length. So we already have transfer pricing for this. But if there are certain transactions which are outside the transfer pricing, then on them only GAR will be applicable. So the transactions which are covered within transfer pricing, for them there is no need of GAR. For the transactions which will not be covered in the transfer pricing, for them this particular point is there. Now let's take an example. Suppose there is a company from US. It has entered into an agreement with Indian company for setting up a power plant in India. Now the agreement says that there will be $100 invoice which will be there for the services. So there is this US company and it is providing the services of setting up the power plant to Indian company, and $100 is the invoice. But the breakup of invoice is that say for example 10 million is for the designing charges, $70 is for the offshore supply, right? And $20 is for the local supply. Now, if you remember your international tax class, you would have learned that offshore supplies are not taxable in absence of any PE in India. So what this company has deliberately done is that it has increased it has increased the invoice value of the offshore supplies because it will not be taxable, and it has reduced the amount of offshore design services because those will be taxable. So it has broken up the structure of invoice into such a way that the offshore supply, which is not taxable, is more, and the design is less, which is taxable. So here, the main purpose of the transaction is to obtain the tax benefit, and it is seen that to an unrelated party, the design services would have been more. And therefore, it shows that the transactions are not at arm's length, and hence the GAR can be invoked in such a case. This will not be covered by transfer pricing. Why? Because they are not associated enterprise. If they would have been associated enterprise, GAR would not have been applicable. Only transfer pricing provisions would have been applicable. But here they are not associated enterprise. So here there is no question of GAR being applicable. Here there is no question of transfer pricing being applicable. Here GAR will be applicable. So the provisions or the transactions which are outside the purview of transfer pricing will be covered under first limb, which is where the transactions are not at arm's length. Is that clear till now? Any doubt? Yes, Namita, you can use the GAR provision, but it has to obtain the approval from the approving panel. We have done that already under the assessment procedure chapter. If you remember, we will revise it again also. The second tainted test is an arrangement which results in misuse or abuse of the provisions of the law, which means that the law is followed in letter but not with the intent, which is what the tax avoidance is, isn't it? Let's take another example for this. Say, for example, there is a company A Limited. Now, if it would have directly invested in India, and if it would have sold this Indian company's asset, there would have been capital gain under the treaty between, say, India and US. So what it does is, it breaks itself into two companies, which is X and Y, and then these two companies invest in India because these companies are, say, located in France. And as for India-France TPAA, if the holding is less than 10%, no capital gain. So instead of directly investing, it has broken up its investment less than 10% in both these companies, which will invest in India. So it clearly shows that it has opened up these two companies in France for the purpose of taking the capital gain exemption, and that is why it has kept the shareholding also less than 10%. So this is clearly with the intention of obtaining the tax benefit under the treaty. And what section 90 subsection 2A says that GAR will apply notwithstanding the treaty benefit. If any question comes like that, you have to write section 90 subsection 2A. Also, there is no commercial substance in these subsidiary, and therefore it falls in the second limb, which is that this is only for following the letter of the law and not the spirit of the law. The treaty is not for giving the benefit to the sham transaction. So therefore it results in misuse or abuse of the law, and hence the GAR can be invoked. And if the GAR is invoked, these two subsidiaries will be deemed as not existing, or it will be deemed as they are only one, so that more than 10% will happen, and even in the India-France there will be taxability. Is that clear? Similarly, the third tainted elements, arrangement which lacks commercial substance. Now that is defined. Arrangement which lacks commercial substance. This is defined in section 97. What does that mean? Certain arrangements are deemed to have lacked commercial substance, which are form, arrangement where form is different from substance. So the arrangement where the substance or the effect of the arrangement is inconsistent or differs significantly from the form of its individual steps or part. Round tripping. I will explain you what is the meaning of round tripping. Accommodating party. Elements that have the effect of offsetting or cancelling each other. Offsetting or cancelling arrangements. Transaction which is conducted through person and disguises the value, location, source or control of funds. Disguising source, location of funds. Location of an asset or of a transaction or residence is without any commercial purpose. Location of asset, transaction or purpose is without commercial purpose. And finally, last one, there is no significant effect on the business risk or cash flows of the party to the arrangement. No significant effect on business risk or cash flows. Now let's understand one by one. These are all the arrangements which lack commercial substance, and any arrangement which lacks commercial substance is also an impermissible avoidance arrangement. Right? Now let's try and understand this one by one. Form is different from the substance. That we all know, that if the form is different from the substance, then this means that your transaction, your agreement shows one thing, but in actual that transaction is entirely sham. Or if you say that you have a company in Mauritius, but that company in effect does nothing, so your form is different from substance. Round tripping. Now what is the meaning of round tripping? Round tripping is also explained in section 97. It means that the arrangement in which through a series of transactions, the funds are transferred amongst the parties and transactions do not have any commercial purpose. Let me give you an example for the round tripping. Say for example, there is Mr. A, who is an Indian resident. Now he wants to invest in the shares of Indian companies listed on stock exchange. If he trades in it, he will have capital gain. So what he will do is, he will open up a company in Mauritius, give the funds to the Mauritius company, and this Mauritian company will then invest and trade in Indian companies. So this is what is happening is that there is a round tripping here and the same funds are coming here. So instead of funds going from year to year, they are going outside and coming back to India. Why? Because here India Mauritius capital gain is not there. So this is called round tripping. Are we clear? Is that clear? So GAR will not be invoked merely on the ground that an entity is located in a tax efficient jurisdiction. What needs to be seen is that the main purpose is the tax benefit. So merely because the company is in Mauritius, that will not mean the GAR will be invoked. If the benefit, tax benefit is the main purpose, then only the GAR will be invoked. Clear? Third one, accommodating party. Now, what is accommodating party? Let's try and understand. Accommodating parties are generally facilitating the transaction for the assessee in a tax efficient manner. Right? So, what is accommodating party? Let's try and understand. Say, for example, there is this Indian company. This is exporting goods to, say, AINC, Dubai. Now, AINC is owned by, say, Mr. Sharaf, who is UAE resident and who is not connected with ICO. Now, AINC again sells these goods to the customer. And in Dubai, there is no taxation. Right? Now, what happened after a few years, AINC will give a loan to ICO. And ICO will say, I'm not able to repay, my financial condition is bad. So the loan gets a write-off. So if you see the profits of the ICO has exported, AINC has again sold these profits to customers, sold these goods to customer and earned the profits. Now, as I said, in Dubai, there is no tax. Right? Here, there is no tax on the profits. Now, by way of loan, which is not going to be repaid, these profits are transferred back to ICO. Right? So, therefore, AINC will be an accommodating party. And this can be disregarded if the GAR is applicable. Are we clear? Any doubt? Did you understand the meaning of the accommodating party, which helps in tax efficiency of the transaction? Clear? Next was offsetting or cancelling the arrangements. So one arrangement is cancelled with the other. So in one thing you have got the benefit, another you have a loss. So you cancel with each other. So if you, for example, you have earned a profit and at the same time you have a loss. So you have deliberated, you have incurred a loss on some other transaction so that you can set it off with each other. That is offsetting or cancelling arrangements. Disguising the source location of the fund. So as I said, say for example, there is an Indian company. It has a wholly owned subsidiary in Mauritius. Right? Now, Mauritius company, if it will give loan to the Indian company, Deemed dividend will be attractive because loan to a shareholder, right? So let me give you an example. Say for example, ABINC, Mauritius, A Limited, India. This is wholly owned subsidiary. Now, if it gives loan, it will be deemed dividend, right? Under section 222E. So what it does is, it will give a deposit to a Mauritius bank, which will then give loan to A Limited. So Mauritius bank will give it to A Limited, there will be no deemed dividend, right? Further, any interest payment by A Limited to Mauritius bank will be exempt because India-Mauritius treaty provides for exemption of interest to the bank. So what is happening? Here the Mauritius bank is kind of acting as an accommodating party, plus the value location source is disguised. The main arrangement is entered into for the purpose of saving the taxes. The arrangement disguises the source of the funds. Right? Here, Mauritius bank is also acting as an accommodated party. In such a case, GAR will be applicable. Are we clear? Namita, there is exchange of information through which the AO comes to know. Under the treaties, we have exchange of information where one country exchanges information about each other's residents to other country. Clear? Location of asset, transaction or purpose is without commercial substance or commercial purpose. Let's try and understand this thing. Let's try and understand this particular thing. So, there is, I'll take you through the example in your module only. This is example from your module. So here it is. Say for example, this is Z Limited, which is a company resident in India. This Z Limited is a company resident in India. Right? Now, Y Limited is a company incorporated in country C1. There is A Limited, which is a company incorporated in F1. And it is 100% subsidiary of Y Limited. Now, A Limited and Z Limited form a joint venture company, which is X Limited. There is no other activity in A Limited. Now, why this joint venture is formed? Let's try and understand. Let me just redraw it for the purpose of your clarity. So, as I said, there is Y Limited, in which Z has the investment, Y has made investment in A and Z have together made investment in X Limited. Right? Now, what is their purpose of doing this transaction? The treaty between, say for example, let's name this country as Mauritius. This is India. Right? And this is, let's keep it as C1 only, or US. Now what is happening? The India and Mauritius treaty, as I told you, does not provide for taxability of capital gain in the source country. Plus, Mauritius also does not have any capital gains in its domestic law. Now, A Limited, which is there, is holding the shares, but all the rights of voting, management and control is with Y Limited only. So, though A Limited is holding the shares of X Limited, but the beneficial owner of Z is Y. Of X is Y. So A Limited is just a sham entity. Right? Are you understanding that? Now, if the shares of the X are sold by A Limited to some another company, then they will say that the capital gain is exempt in India and Mauritius. So if you see, the arrangement of routing investment through Mauritius is just for the tax benefit. There is no other purpose of incorporating A Limited. The main purpose is to obtain the tax benefit. Here there is no commercial substance in incorporating A Limited, and the location of the asset is without any commercial purpose, and therefore here the GAR can be invoked. Are we clear? Here the GAR can be invoked. Is that clear? Any doubt? Namita, the AO, if he has doubt, he will open up the assessment and he will come to know from that. Is that clear? So that is the impermissible avoidance arrangement. Right? And last is no significant effect on business risk or cash flow. So that means that the entity is just there for sham purpose. There is no effect on cash flows, meaning that the cash flows are not changing in reality. If the cash flows or the business risk have some implication, means that entity is doing some business. Because if you do not take risk, means you are not doing any business, right? Now, this is the definition of impermissible avoidance arrangement. First was creating rights or obligations which are not created at arm's length price, results in abuse or provision, misuse of provision of act, lacks commercial substance, and the final one is entered without any bona fide purpose, which is very clear. Now, what if the arrangement is an impermissible avoidance arrangement? What happens? If the arrangement is an impermissible avoidance arrangement, then what? Then the GAR will be applicable, as I said, if the main purpose is to obtain the tax benefit. And what is tax benefit? Tax benefit is also defined under 102. It means, tax benefit means, what is tax benefit? Avoidance or deferral of tax, including surcharge, cess, interest, but not penalties. Results in a refund of tax, decreases the total income, increases the losses. That is the tax benefit, right? So tax benefit can be increase in loss, can be reduction in total income, can be reduction in tax liability, can be increase in refund, right? So if there is a tax benefit, the GAR will be applicable. But what will happen if the GAR is applicable? If the GAR becomes applicable, understand one thing. The GAR will disregard the part or whole of the impermissible avoidance arrangement. It can disregard, it can combine, or it can recharacterize the entire arrangement. What does it mean? So say for example in this case, here clearly this A will be disregarded. And it will be considered that Y has made the investment. Similarly, in this case, AINC will be disregarded and it will be seen that it will be assumed that it was never there. And then what is the effect of the transaction? What will be the tax without considering AINC? If AINC would not have been there, what would have been there and then what would have been taxed? Therefore, that will be considered. Similarly, here it will be assumed Mauritius Bank never existed. Then ABINC, if it would have directly given the loan, what would have been in effect? Deemed dividend. Okay, tax it. So what will GAR do? GAR will disregard, combine or recharacterize any step or whole of the impermissible avoidance arrangement. It will treat that the impermissible avoidance arrangement has not been entered into ever. It will disregard any accommodating party or treat the accommodating party and any other person as same. It will reallocate the income and expenditure. It may reassign the place of business, place of residence or place of asset. It can look through any arrangement and disregard the entire corporate structure. So GAR is reinforcing the substance over form approach. The first onus is on the AO to prove that yes, there exists an impermissible avoidance arrangement. Once the AO is able to prove it, then the onus shifts on the assessee to rebut the proof of the AO or to rebut the revenues argument. Are we clear? So the GAR is going to reclassify everything. Any doubts till now? Any doubt? Okay. Have you understood clearly the GAR? So case studies can come from this particular topic. Now before we go towards the discussion of the case study, there is a Cbd circular which says that, which discusses about the GAR. It says that GAR will not be applicable to foreign institutional investors who have not taken benefit of the tax treaty and who have invested in listed securities. It will not be applicable to the investments made before 1st of April 2017. There is a grandfathering which is provided so that the GAR is not made applicable retrospectively. Is that clear? And as I said, the GAR can be invoked by the assessing officer only by making a reference to the commissioner under 144BA by issuing a notice in the writing to the assessee seeking any objections to the applicability of GAR. So if you remember, we had done that GAR is applicable only after the AO obtains the permission. Only after the AO obtains the permission, only after the approval. Also, as I had told you, there is an approving panel. There was an approving panel, right? Which decides upon the applicability of the GAR. The reference has to be made to the principal commissioner. So what happens is, for the GAR applicability, the AO first makes a reference to the principal commissioner or commissioner at the stage of assessment or reassessment proceedings to declare the arrangement as impermissible avoidance arrangement. Then the principal commissioner or CID issues the notice to the assessee for submitting his objections by providing an opportunity of being heard within a period not exceeding 60 days. If the assessee does not furnish any objections, then the PCID may issue the directions for declaring the arrangement as an impermissible avoidance arrangement. Right? And if the assessee objects, if the CID is satisfied with the explanation, the CID will communicate the same to the AO and will give an order copy to the assessee also. But if the CID is not satisfied with the explanation of assessee, then CID will make a reference to the approving panel. So AO will first refer to CID or PCID. PCID, if he is not satisfied with the assessee's objection, he will invite the assessee's objection. If he is not satisfied, then he will also make a reference to the approving panel. And if the assessee does not furnish any objection, then he will issue the directions for declaring the arrangement as impermissible avoidance arrangement by making a reference to approving panel. Now, approving panel again will give an opportunity to the assessee. Approving panel will make further inquiries, will call for documentation, will call for information, and then approving panel will issue the directions for declaring an arrangement as impermissible avoidance arrangement within 6 months from the month of the receipt of reference. And the directions of the approving panel are binding on the assessee, on the principal commissioner, and all the assessing officer. AO will complete the proceedings in accordance with the direction of approving panel, and prior approval of the CIT again is required for passing assessment order. Further, no appeal will lie against the directions of the approving panel. Few days back, the approving panel has been appointed for GAR. Just few days back. Last week only, I think the approving panel was appointed. And there are 3 members into the approving panel. One is the chairman, who is a judge of High Court. One is an IRS officer, and one is an academic or scholar. So the approving panel has 3 members, and ordinarily they have term of 1 year, but which is till 3 years. Is that clear? So an approving panel has been very recently appointed, and it has 3 approving members. 3 panel members. Is that clear? Any doubt? Any doubt? Any questions? Any doubt? No, if the assessee objects, then as I said, it has to object before the principal commissioner. Clear, Namita? Do you know who is going to head approving panel? The first panel, which is going to be headed by Justice Chandrasekhar, who is retired High Court Judge of Delhi, Mr. Rajat Bansal, who is IRS officer, and Professor Nigam Nageli, who is from NLSIU Bangalore. These 3 are, as I said, one is the IRS officer, one is retired High Court judge, and the third is academician. These 3 will be the members of the approving panel. Clear? Now the CBDT, as I said, has clarified the applicability of GAR. And as I said, one of the questions was that whether GAR will be invoked if SAR is applicable. So they have said GAR and SAR can coexist. Of course, when SAR is applicable, and if SAR is able to resolve that or tackle that tax avoidance, GAR will not apply, but they can coexist. As I said, I gave you transfer pricing example. If it is between AE, TP will apply. If it is between non-AE, then GAR will be applied. Clear? Another question before CBDT was that whether GAR will interplay with the right of the taxpayer to select or choose the method of implementing transaction. Say, for example, if the assessee wants to go for company but not for LLP, will GAR be applicable? Answer is no. The CBDT also says it. That GAR will not interplay with the right of the taxpayer to select or choose the method of implementing a transaction. Is that clear? Next question was that whether GAR will be applicable where the location of foreign portfolio investor is based on non-commercial, non-tax reasons and commercial reasons. But just because it is located in a tax-friendly jurisdiction like Mauritius, will GAR be automatically invoked? Answer is no. They have said that for GAR application, the choice of entity location will not be attacked by GAR. What GAR looks into is that the main purpose of the transaction was to avoid tax. Just because an entity is located in Mauritius, that does not mean GAR will apply directly. Is that clear? The next question before the CBDT was, as I said, GAR is not applicable to transactions or investments before 2017. They are grandfathered. Now, what if the shares were issued before 2017, the compulsory convertible debentures or the original shares? Now the bonus shares are issued after 2017. or the compulsory convertible debentures were there and now they are converted into shares after 2017. So what will happen in those cases? Will even the bonus shares which are issued on the original share, or for that matter, the compulsory convertible debentures which are now converted into shares, will also be eligible for the grandfathering? So the CBDT says that the grandfathering will be available to investments prior to 2017, and shares brought into existence by way of bonus, by way of compulsorily converting them, will also be eligible for grandfathering. Is that clear? Will also be eligible for grandfathering. Further question is where the NCLT has given say an approval to a merger, will it be subject to GAR then? So the CBDT says that where the court has explicitly given the approval to a merger transaction or to any other transaction, then GAR will not apply because the court has already examined all the consequences of that. So then the GAR will not be applicable. Another question posed to CBDT was that, say for example, in 1 year I am claiming treaty benefit. In second year I am claiming the benefit under the Income Tax Act because now the act is more beneficial. So whether it will result in claiming whether it will result in applicability of GAR? Answer is no. So GAR is applicable only to impermissible avoidance arrangement. So if you have claimed act in 1 year because that is beneficial and treaty in another year because that is beneficial, GAR will not be applicable. Is that clear? Any doubt? Any doubt? Okay. Let's do case studies then. Let's do case study if there are no questions. Yes, Vidula, I will share all the notes. I have shared the notes of GAR already also, and this also notes I will share. Again, Namita, the approving panel will also give the opportunity of being heard to the assessee, and he also can present the objections there also. Clear, Namita? Namita, issue of bonus shares on the original shares issued prior to 2017 will also not be attracted under GAR. Clear? Okay. There are few case studies in your module. Let's deal with it. Let me just open up and then you can answer to me. So question 6 is in front of you. Measures Global Architects Inc. is a company incorporated in country F1. It is engaged in the business of providing architectural design services all over the world. It receives an offer from Lovely Resorts Private Limited, an Indian company for design and development of resorts all over India. India F1 tax treaty provides that architectural services are technical services and payment for the same to a company may be taxed in India. However, if such professional services are provided by a firm or individual, then payment for such services are taxable only if a firm has a fixed base in India or stay of partners in India exceed 180 days. Limitation of benefit clause does not exist in tax treaty between India F1. Measures Global Architect Inc. forms a partnership firm with a third party director of the company having only a nominal share in F1. The firm enters into an agreement to carry out the services in India. The company seconded its trained manpower to the firm. Thus, the partnership firm claimed the treaty benefit and no tax was paid in India. Can such an arrangement be examined under the GAR? What is limitation of benefit clause? Limitation of benefit is an article under the tax treaty which limits the treaty benefit in case there is abuse. It's a specific anti-avoidance provision which limits the treaty benefit in case there is an abuse. So if limitation of benefit clause exists, still GAR can exist. That's what CBDT says, that SAR and GAR can coexist. If limitation of benefit clause is not able to tackle tax avoidance, GAR can still apply. But what will be your answer in this case? Namita and grandfathering, if the shares issued prior to 17 are not covered by GAR, the question is whether any transaction which is abusive, which is after 2017, say by way of issue of bonus shares. Now, bonus shares have been issued on original shares issued prior to 2017. Original shares are covered by grandfathering. So, whether the bonus shares also can be protected by grandfathering or for them the GAR will be applicable, that's the question. What will be your answer in this case? Yes, Priya, you are correct. Others, please give finally answers. Fast. GAR can be invoked or not? Very simple question. Yes, Vidula, correct. Okay. So understand one thing here carefully, that if you see the firm was incorporated just to take the benefit, then if the firm is incorporated, it will be taxable. The technical services will be taxable only if there is a fixed base. So yes, the main purpose of the transaction was to avoid the tax benefit, was to get the tax benefit. Yes, Malvika, correct. Yes, Jayadev. So therefore, there is an impermissible avoidance arrangement which lacks commercial substance also. Because here, if you see, the firm did not have anything, it was just it was having just a nominal share in F1. And the company only had seconded its manpower to the firm. So firm was sham as such. And therefore, since it was impermissible avoidance arrangement, the GAR will be applicable in this case. Is that clear? Clear? Okay, let's proceed further. Next question. Question number 4. The merger of a loss-making company with a profit-making one results in losses setting off profits, a lower net profit and a lower tax liability of the merged company. Would the losses be disallowed by applying GAR? In the above facts, let us presume the profit-making company merges with the loss-making one. This results in losses setting off profit, a lower net profit and a lower tax liability for both companies taken together. Can this be examined under GAR? So in first case, it is loss-making company merging with profit one, and in the second case, a profit-making company is merging with loss. What are your answers? Namita, all the notes are uploaded. Even the transfer pricing notes have been uploaded. Today, GAR notes also have been uploaded. Yes, Naveen, correct. But what about the second case? Yes, Namita, correct. Okay, let's understand. So in the first case, it is a loss-making company merging with a profit-making. So there are already safeguards in place. If the loss-making company is merging with the profit-making company, there are specific SAR which are there. That how many years the losses can be carried forward. If there is change in the shareholding of the company, section 79 is there. So we already have SAR. Now, if it is covered by SAR, GAR will not apply. If it is not covered by SAR, GAR will be applicable. In the second case, the profit-making company merges with a loss-making one. Now, if it is by a court order, GAR will not be applicable. However, if it is not by a court order, GAR can be invoked if the main purpose is to obtain the tax benefit. Is that clear? Is that clear? Last question. Question number 5. A choice is made by a company by acquiring an asset over lease over outright purchase. Company claims deduction for lease rentals in case of acquisition through lease rather than depreciation as in the case of purchase of asset. Would the lease rent payment being higher than the depreciation be disallowed as expense under GAR? What do you think? Yes, Vidula, you were correct. Yes, Malvika. Naveen, yes. No, Priya. Namita, no. So here understand, here the assessee is just selecting a methodology to buy the asset, either to take it on lease or on the way or by way of the acquisition. So GAR will not interfere with the right of the taxpayer to select any choice. It is upon him. It's just like if I want to go for a company or for a partnership firm for carrying on my business. GAR will not interfere with that. That is a tax planning. That is not covered by GAR. So GAR will not interfere with the right of the taxpayer to select the method of doing his business. Are we clear? So in this case, GAR will not be applicable. Now, if you have any questions, you can ask me, else we can just close the session. And I suppose this was the last session. Yes, Vidula, correct. You have 2 minutes time. Namita, these are uploaded then and there on the PGBP post reduction of chapter 6. You can just write an email to them if they are not visible to you, but they are uploaded already. Any other question, any doubt before we close the session? Thanks, Malvika. Thank you so much. Namita, in that case, they may be taken up later, possibly. Thanks, Vidula. Thank you, Naveen. Thanks, Jaydev. Namita, you can mail your queries if you have any. Namita, you can write to BOS and they will send it out the responses for your queries. Okay, so shall we close the session? Thank you, Namita. Thank you so much. All the best, guys. Thank you so much. Good night.